Happy Fabulous Friday. I hope you're feeling good. But if your money is on the stock market, you might be feeling some kind of way. So, listen, I wanted to jump on here for about 10 or 15 minutes and give you another option. Does that sound good? All right. So, come on in here, listen, hit the like button, share, and comment. All right. So without further delay, let me share my screen with you. So listen closely. How do you get paid interest on your money? This is a quick lesson that we should have learned in high school. There's three ways to get paid interest on your money. The first way is to put it in a fixed bank account or a fixed account. Fixed is just simply a fixed interest rate. It means that no matter what happens to the economy, you're always going to get paid this fixed interest rate or guaranteed interest rate. Now, the good thing about this is you won't lose any money, right? But the bad thing about this is if the fixed interest rate is too low, your money will still depreciate in value. Most fixed accounts pay less than the cost of living increase. You must have at least 5% interest on your money, or your money will be slowly depreciating in value. So if you have a fixed account and you have at least 6 months worth of emergency funds in there, we want to recommend that you diversify or get some of the money out of that fixed account so that your money is not all depreciating in value. You don't want a big chunk of money sitting in a low paying CD or a low paying bank account, because as time goes by, you're losing buying power on that money. So again, a fixed interest rate is just simply a guaranteed interest rate. It's also called a floor, so that when the stock market crashes, your money sits on the floor of that guaranteed interest rate. In the industry, we call that flatlining. Just like when you go into the emergency room and you see boom and you know the person died, your money decreases in value or it flatlines, but at least you're not losing your principal or the money that you put in there. The second type of account is called a variable account. Now, this is where you are buying stocks on the stock market so that when the stock goes up, your money goes up. But when the stock goes down, you lose money. Right now, the stock market is extremely volatile, which means that it's going way, 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 way down. Hundreds and thousands, trillions, billions of dollars are being lost at this second on the US stock market. So right now, you may be feeling a little bit of fear. Even if you are a savvy investor, you will hear that there is a fear out there. So just know that when your money is in a variable account, you're buying stocks. When the stock goes up, your money will go up. But when the stock goes down, your money goes down. Now, listen, some people say, well, that's okay. It'll come back. Yes, it will come back, which means you may get your principal back. But that doesn't mean that you are going to gain any interest on your money. If you've lost $100,000 and you only make $100,000 a year, it would take 10 years or more of interest being earned on your money just to break even in one of those retirement plans. The second or the third way to be paid on your money is the way that stockbrokers don't want you to know about, because they don't get paid any commissions from this type of account. This account is called a fixed indexed account. This account has a guaranteed interest rate so that when the stock market crashes, you don't lose a dime, and your money will even grow by a small amount. Your guaranteed interest rate might be 0, or it might be 1%. If you work with our firm, we have floors that still pay you 2 to 3%. So that when everybody else is losing their money, you'll still be earning a small amount of interest. But when the stock market goes up, your money mirrors the stock market. So you have guaranteed interest or a floor on your money and stock market gains. No losses and stock market gains. This type of account is called a fixed index account or an equity index account. So my question to you is, which one of these types of accounts do you feel is best for your retirement money? Now, with that question being put out there, I am going to open up my cell phone and I'm going to take a look on social media and see if anybody is able to chime in. Let's take a look here. Okay. All right. So moving on. So listen, here are the 3 graphs. This is a graph of the S&P 500 during one of the worst economic times in American history. And this is someone who had $100,000 set aside in their retirement plan. So this person put their money in a variable account, which means the stocks went up and then they went way down. But notice that if they had to pull their money out while the stock market was down, which means they had to retire, this person lost 30% of the value of their account. And they still had to pay taxes. Both state and federal taxes still came out of their retirement balance after they lost 30% of their money. Think about that. Okay? Think about that. This person went to the bank and got a fixed IRA, which means they earned a steady 4% interest on their money. Notice that their money did not grow as well after 20 years, and they still had to pay what? Taxes. The bank sent them a 1099, and they still had to pay state and federal taxes after their money didn't grow well. The person in the green got an equity index account so that when the stock market crashed, their money sat on the floor and they didn't lose a dime. And when the stock market went up, their money grew 12%, 14%, 20%. So they didn't have the emotional fear that comes when you're losing large amounts of money in your retirement plan. And what we did, was a backdoor Roth. So at the end of their retirement, when they were ready to take the money out, we did a backdoor Roth conversion and transferred their money out of the public banking system and put it into the private banking system. So at the end of their retirement, they took no losses and they paid no taxes. Again, they took no stock market losses. And because they work with our firm, and we did this private backdoor Roth conversion, they paid no taxes. So, what is it that I would admonish you to do? Actually, I'm going to show you just one more slide. Here is a client of mine who took 200. Well, let's go back here. Here's a client of mine who took $242,000 from her 401k and rolled it over into a fixed indexed account. Notice that when she did that, the company paid her an immediate bonus of $24,000. She let the money sit there and cook for 1 year, so that at the end of the year, she got stock market gains, both international stock and US stock, and she took no losses. And at the end of the year, she got another bonus on top of her money. These accounts pay extra bonuses every year you keep them. She decided she needed her money after 1 year. And then after 1 year, she began to withdraw 8% of the entire balance of her account. The life insurance company is paying her an 8% roll up. So she can take an income of 8% of the total balance of her account, and it will be paid to her for the rest of her life, never withdrawing her money down to the line of zero. Now, some of you are saying, but Richelle, you said she took it out of a 401k. So doesn't that mean she's going to have to pay taxes? No, because after she worked with us for 1 year, we put her in touch with our wealth management consultants and our legal firm, and she was able to do a backdoor Roth conversion. So she was able to take 8% of her balance, which is over $24,000 a year, for the rest of her life, tax free. So, what is the next step for you? I want to encourage you to do a 45-minute green sheet consultation with me. The first time we meet is going to be a free 30-minute consultation where we're just getting to know one another. I'm asking you what brings you to the call, and you're letting me know what's happening. And then in exchange, I'll tell you what it is we can do for you. And then if you decide that I should be your financial advisor, then we will do a second appointment, and we will do a green sheet fact finder consultation. And this green sheet will help you identify money that you didn't know you had. In exchange for these services, I am one of the only brokers who will not take a financial advisor fee from you. In exchange, before you come back for a green sheet appointment, I'm going to ask you for one thing: referrals. 10 referrals. Who do you know that I should know? Who do you know that I can help? Once you exchange the referrals, We'll finish the fact finder and I will show you the money. All right. So I want to encourage you. I will drop a link in this chat. Set up a 30-minute Zoom call with me where we can chat about what's happening with your retirement account. I will give you tips on how to preserve and rescue the money until you're able to transfer it into a backdoor Roth conversion. All right. My name is Richelle Dickerson. I'm the CEO of Rhema Financial Solutions, and I look forward to working with you and your family. Be blessed. You are too blessed to stress, and I'll see you soon.